Hello, everybody, and welcome back to the Last Honest Realtor podcast. I'm your host, David Fleming. Thank you so much for joining me today in what is the third podcast of 2026. Last week, I decided that from now on, I would have a bit of a tradition here on the podcast where I would, copy Jimmy Kimmel, go back and read the meanest thing that was written about me the week before. And unfortunately, there was no such comment from last week, which is kind of good, I guess, and maybe not so much. So I decided to go to my pick five. And I had a lot of comments on one of my pick five videos. I did it about $400,000 condos. Here's a comment that I really liked. For $400,000, I expect at least a 900 square foot true 2-bedroom with a den, 2 bathrooms, a parking spot in the underground garage, a locker, and max $550 in maintenance fees, as well as $2,000 tops in annual taxes. And then I thought, what would my response be to this? It's kind of like the 500-pound slob sitting on the couch watching the Victoria's Secrets fashion show and saying, the one on the left's a little bit rotund. I don't know. That was the best analogy I could come up with. No, what it is just kind of crazy and delusional. It's like saying, I understand that there's $12 of ingredients that go into making a pizza, but I only want to pay $1 for it. Funny thing is, in this example, $444 a square foot is the math. Replacement value is $1,000 and average in Toronto is $800. Maintenance fees of 60 cents, you can't run a building on that. And the taxes are set by the municipality. So good luck with that. Anyways, maybe next week we'll have a better comment for me to poke fun at, as well as poking fun at myself. That is, of course, what the YouTube comments section is for. So today, folks, if you're watching this or listening to this, you obviously read the title and were intrigued by the words crash, correction, and recovery. Now, the reason I want to talk about this is twofold, really. I mean, first of all, people love to sensationalize. Across the board, everything in life, real estate is no different. And number two, because people have very different ideas of what these words mean. So given that we are now into February and we have the first data point for the year, or data, if you'd like, garage, our data point for January is available. We can now finally assess what is happening in 2026 so far, of course, with the caveat of it's only January. But I want to do that. I want to talk about crashes, corrections, and recoveries, and then I want to go into January real estate data. So I'll say this, folks, right off the hop. I would like for you to describe what you believe a market crash is. How do you do that? Do you explain what transpires? Do you look at timelines and percentages? If you were to go to Google and look at their AI function, which of course is huge now, and interestingly enough, they pick up a lot of stuff I've written over the last 18 years, which is kind of neat to answer questions that people ask. And the other thing I'm learning, I'm explaining this to people that are obviously watching videos, so it's kind of like, why are you telling me this, David? But way more people are putting questions into Google now, and that is why they're getting answers that are pulled through the AI, things such as my blog and, of course, many other real estate agents' websites as well. I find that very, very fascinating. Thank you, David, for explaining to us how the internet works. So Google's AI function says this, how a crash happens. Number one, you have a bubble formation, a run-up based on low interest rates, loose lending, and speculation. They drive demand, causing prices to increase rapidly, creating a bubble. We'll come back to that. Second part is unsustainable growth. Prices become inflated far beyond what people can afford, often with risky mortgages. Come back to that as well. Then the burst, the crash, the economic shift, interest rates rise, the economy slows, or jobs are lost, reducing affordability and demand. There's oversupply. Builders continue construction, adding to inventory while demand falls, and a loss of confidence. Buyers disappear, sellers panic, and prices plummet. That all sounds great in theory. However, if we work backwards here, oversupply, builders continue construction. No one's building anything in Toronto right now. Adding to inventory while demand falls, not happening in Toronto. Loss of confidence, buyers disappear, sellers panic, and prices plummet. Prices plummet, crash, we need definitions there. It's one thing to say crash, it's one thing to say plummet. Talk to me about numbers, folks. And then when you go back to the beginning, low interest rates, we saw that. Loose lending, we did not have loose lending. Absolutely not. We have the most stringent banking system in the world. This is not 2008 in the United States. Speculation drives demand. Yes, absolutely that happened. Prices rose rapidly, creating a bubble. Again, define bubble. Unsustainable growth. Prices become inflated far beyond what people can afford, often with risky mortgages. Again, we do not have risky mortgages in Canada. We have the most stringent banking system in the world. So what I would say to this, oh my God, how's this going to come off? And then the guy on the podcast said Google's wrong. No, what I'm saying is that Google's AI algorithm pulled this from someone's website somewhere, and some of it is correct, some of it is not. A solid definition and a start, but there's a couple things missing. One important piece. Do you know where I'm going with this? Prices or percentages. Nowhere are we seeing prices or percentages. And for you to define what is a crash, what is a correction, I've got to have prices. So before I get into that, I want to tell two stories, which I tell a lot on Toronto Realty blog, and these are two of my favorite stories, just to put crashes and corrections into context. I started in this business in 2004. I finished university in, I can't remember, 02, 03, 03. So I went to work for, I'm not gonna get into my life history here, but I worked two jobs. I worked at TD Bank as a teller. That was a scene, man. And then I also worked with a gentleman that was building his own house. Now, very successful guy in a ton of different industries, had been successful at anything and everything he had ever done. And I was working construction for him because I was learning how to build houses from the ground up. He said to me, and I quote, "Now is a terrible time for you to be going into real estate because the market is going to crash." That was in 2003. The average home price increased in 03, 04, 05, 06, and I'll skip the rest and get to 17. This gentleman, who was one of the most successful people I'd ever met, told me the real estate market was going to crash, and then it went up another 14 years straight. Now, he probably thought it was going to crash because historically market cycles are anywhere from 5 to 7 years. Goes up, comes down, goes up, comes down. And I believe it was 96 to 97. That was when the average home price declined, and then it increased every year through 2003. So if you're looking at this idea of a 5 to 7 year period before a market correction, not necessarily crash, this gentleman would have been right. Now, my second story, this one I hope doesn't come off as tacky because I'm going to make fun of the childhood friend, but it's hilarious. We all had that friend when we were growing up, the know-it-all. Now, this particular know-it-all drove me crazy. I'm like, well, why were you friends? I don't know. Why were you friends with anyone when you were a kid? But everything out of this guy's mouth was, my dad says, like, do you have any original thoughts of your own, or are you just going to tell us what daddy said? So he told me, we had our family home, and I believe it was around 2006, and he very casually said to me, you know what you should do? You should sell your parents' house, convince them that now's the time, and then a year from now, you should buy it back for half. Okay, cool, man. Like, where'd you get that idea? Well, my dad says, and then it just went on to my dad says. Now, here's a dad who, again, in the 80s, 90s, and early 2000s, incredibly successful person. Now, his son aside, who would just parrot everything that he said, his son said that I should tell my parents to sell the house and buy it back 1 year later for half. That is a crash. If a market goes down 50% inside of a year, that is a crash. Of course, as we know, that did not happen. The market continued to go up every single year for 11 years. So, folks, my point is this. It's nearly impossible to predict a crash, as we've all seen over the last 30 years. But to define a crash is no simple task either. Not only that, we need to define a correction as well, while attempting to differentiate between a crash and a correction. Now, I know that many of the people that watch this video series or read Toronto Realty blog work in banking, finance, economics, public policy. So I invite you, I implore you in the comment section below to tell me what a crash or correction is. Use percentages, use timelines. And if you simply want to say, you know, David, you're a loudmouth real estate agent and the market's going to crash and it's terrible, I don't know, maybe I'll read that next week. But go ahead and put a number to it while you're there. So I believe that in order to define a crash or a correction, two important elements must be present. Number one, the amount of the decline as a percentage. Of course, it's a moving target because you have the GTA average home price, the 416, you have the home price index. You can specifically look at the average condo price, average detached. Pick your poison if you will. But the second point, folks, and this is crucial, you have to look at the elapsed time period. So the percentage and the time period. So just as an exercise, go to a search engine and put in crash or correction. And most definitions will not have either of these elements, the amount of the decline as a percentage and the elapsed time period. They define the characteristics of the crash, the reasons, the origin, but they don't really put their money where their mouth is, so to speak. So I am going to do that now. Here's what I believe. A correction is in the neighborhood of 10%. A crash is in the neighborhood of 30%. Okay, cool. Thanks, David. What about 20%? We have to approximate. But this is the point. There's always going to be gray areas and nothing's ever cut and dry. So here is where, that was a bit leading, right? Said 10%, said 30%, but here's where we have to put in the time element, because 10% over 10 years, okay, well, that's not really a correction, is it? So I would offer a 10% decline in 24 months as a correction. What about a 10% decline in 12 months? Correction or crash. What about a 10% decline in 6 months? What about a 10% decline in 2 months? Now, a 10% decline in 2 months could be considered a crash, right? But what about the third element, which is recovery? So riddle me this, Batman. Some of you might not get that reference. For example, okay, the Dow Jones, riddle me this. The Dow Jones at the beginning of the pandemic was around 29,000 in February of 2020. It dropped to 18,000 in April. That's a crash. But by September, it was back above 29,000. Is that a crash? So my third element here, guys, is recovery. If it crashes overnight and comes back, was it a crash? It recovered. And of course, there were a lot of people that panic sold during the pandemic. And then everyone knows that one person that went to cash in Jan and then bought in April, and then but did that person exist? Yeah, I don't know. We all know that one person. Oh, it was probably that friend I had from childhood, right? So in a vacuum, I would say absolutely. The market crashed as the Dow Jones dropped 38% in a period of weeks. That is a crash. But after we saw it recover in September, could we go back and revise our definition of a crash? Because if the Dow Jones stayed at 18,000 or thereabouts, we would call it a crash. But after regaining the ground that it lost, 7 months later, we'd have no choice but to label those events a fluctuation. Okay. Crash, correction, fluctuation, recovery. Now we're on to something. So all this is to say that defining a crash, correction, or fluctuation is completely subjective, and the definitions will differ before, during, and after the events. Revisionist history is real. So let me revise my definitions to include the time period. A market correction is in the neighborhood of 10% inside of 12 months. A market crash is in the neighborhood of 30% inside of 12 months. So following this logic, I would offer a decline of 30% that takes place over 36 months is a correction. I just said 30% is a crash, but over 36 months, that's like an old man slipping into a warm bath. I took that from Seinfeld, I think. That was when Kramer said that George, the ship was sinking. It was like an old man slipping into a warm bath. The point is, it took forever. So do you see where I'm going with this, guys? A crash, in order to be a crash, has to make a bang. 30% over 3 years, there's no bang there. So a 30% decline, which is substantial, cannot be spread over 3 years. And it would be considered a correction. So I want to test this theory. So our market peak was in February of 2022. So when I wrote this, of course, in Jan, we didn't have the Jan data. I didn't want to use December because it's depressed, so I chose November. Tell me I'm cherry picking and I will disagree. But what I want to do is this. I want to look from Feb of 2022, our peak, to November of 2025. It's a period of 45 months. Now, the City of Toronto's average home price was down 14.4%. Is that a crash? 14.4% over 45 months? No, that would be a correction at best. But to be honest, I would probably call it a fluctuation if we're looking long-term, since it took place over 5 years. Now, I'll save you Halton, 23.8%, York, 23.9%, Peel, 26.9%. Save that conversation. Let's just look at Durham, which was the hardest hit from the time period we're looking, which is 45 months from the peak in February of 2022 through our November of 2025 data. Durham was down 31.6%. Now, a 31.6% decline, according to my earlier definition, is in fact a crash. But if it took place over 45 months, there's no bang. That is a correction. So 31.6% decline in 12 months, crash. 31.6% decline in 24 months, crash-ish. 31.6% decline in 45 months, I am not sold. Now, then again, if we consider where the market was before this happened, it could add some perspective. So when we talk about a crash leading to recovery, why don't we work backwards and talk about a boom that leads to a correction, crash, or fluctuation? So let's look back 2 years, only 2 years. So our peak in Feb of 2022, we're gonna go back to Feb of 2020. This is wild. Toronto's up 36.9%. Halton's up 64.2%. York's up 67.3%. Peel's up 67.9%. And Durham up 87.4%. 87.4% in 2 years. So does this all make sense? Because these figures are like mirror images. Toronto, remember, it was down the least, 14.7%, but it went up the least at 36.9. And then when you look at Durham, well, it went down the most, 31.6%, but it went up 87.4% in 24 months. So you go back to the definition that Google AI gave us, hyperappreciation, abso-freaking-lutely. So I'm going to go back to this, guys, and this is not rhetorical. Does a decline of 31.6% in 45 months after an increase of 87.4% in 24 months represent a crash? Now, maybe it is rhetorical, because the answer is no. I would consider that a market fluctuation. There is nothing normal about an 87.4% increase in 24 months. And you might want to argue that this was due to low interest rates. And I think the pandemic had a lot to do with that. We saw more people moving and thus buying and selling during the pandemic than ever before. The buying frenzy, due to both low interest rates and a desire to move, drove people to the suburbs, where we saw ridiculous price growth in that 2-year period, as evidenced by Durham region. Now, I would also offer that the keeping up with the Joneses had a lot to do with it, as society has kind of fallen into a herd mentality, especially when it comes to real estate. Now, regardless, I don't feel as though any of the data presented speaks to an undeniable crash. 87.4% increase in 2 years, followed by a 31.6% decrease in 45 months. That's not a crash, that's a correction. Now, there's one more aspect of the market, especially as it pertains to a crash or a correction, that we have yet to discuss, and that is price versus sales. I have long lamented that the media create their argument by using whatever data point they want. I've always said you can make numbers say anything you want. You can use sales one month, you can use prices the next, you can talk about listings, whatever argument that you are trying to make. So what this does is highlight the possibility of a moving target as it pertains to our definitions of correction, crash, and recovery, or at the very least, different ways of defining these events. Now, when we look at overall sales in the market, we could use this to describe a market crash. Consider this. There were over 122,000 sales in 2021, which is the all-time record. In 2025, that number was almost cut in half, as we only saw 62,000 sales and change. Is that a crash? Perhaps. I think you could argue that it is, but then again, can you really start and use your starting point for basis of comparison with an all-time high? And wouldn't you have to consider prices along with the sales data to really understand whether the market crashed or not? If sales declined by 50% and prices only declined by 15%, this would not be a crash, right? You'd expect in any other market, if sales declined by 50%, prices would absolutely plummet, to use the word from Google AI, thank you. But that is not what happened. So you don't need to answer or even give that question thought. This is merely for illustrative purposes, as I lead into what I do believe unequivocally represents a crash in our market using sales and not prices. Because as I said, we can make our own argument. In the world of new home sales, there is no way of denying that a crash took place, irrespective of price. Because for new condo sales, the following data I'm going to give you fits crash to a T. Let's go back to 2016. These are new condo apartment sales in the GTA. There were 23,000 sales. I'm just going to round. 23,000. 2017, 31,000, all-time high. 2018, there were 18,000. 24,000, 18,000, 30,000 back in 2021. Listen to this, guys. We went from 31,000, I rounded up, in 2021 to 22,000 in 2022 to 12,000 in 2023 to 4,600 in 2024. And in 2025, we saw 1,599 new condo apartment sales in the GTA from 31,000 in 2021. That's a crash. That's absolutely positively a crash. That says nothing of prices. But you can use prices to talk about a crash. You can use sales to talk about a crash. You can pick your data point. But I think this data point was picked for us. There's absolutely no denying it. Now, of course, the media has been talking about the pre-construction market. I've been talking about the pre-construction market. The 1,599 new condo sales on GTA is, let me see here, pi r squared, carry the 1,599 more than I would think there should be, because who in the hell bought a pre-construction condo in 2025 in the GTA. That's absolute madness. I would have thought this number would be, I'm drawing a 0. If you're not watching, if you're listening, maybe you heard the pen, a 0. It could have, would have, should have been a 0. It is a crash. Now, let's say by some miracle, sales dropped to $1,599 in 2025, but prices were identical to those in 2021 and 2022, then I suppose in this absolutely absurd hypothetical scenario, we could deny that the market crashed, because I do believe that you still have to have the relationship between prices and sales. But as we know, prices absolutely plummeted, so the crash is real. Now, pre-construction condominium prices in 21-22 were already 50% higher than comparable resale, which is what I've been talking about for 15 years. So the crash in sales and prices has been absolutely spectacular. All this is to say that while defining a market correction or crash, you might choose to look at prices, sales, or both. I feel to only look at prices is fair, but I feel to only look at sales is not the same thing, unless the crash in sales is completely obliterating the market as it did with new condo sales. Now that market is non-existent right now, and conversations about how the market recovers are far more important than when. There was a lot that was made of this in the media, and I am going to come back to that. But now we've honed in on that fourth little nugget, right? So we talked about crashes, correction, fluctuation. Let's talk about recovery. Now, I'm not trying to create a market narrative here talking about recovery. I don't want this to come off as, hey, the market is depressed right now, and I'm trying to go talk about when and how it's going to recover. I think it's prudent in the context of conversation about what is a crash, what is a correction, what is a fluctuation, to define what a recovery looks like. What it looks like is one thing. How and when it happens is another thing completely. I'm finding right now, people are less concerned with how and more concerned with when. People want dates. Now, in order to consider, define, or discuss recovery, it's prudent to look at the market correction itself. Not only that, I feel the word crash is used far too often to describe a correction, and the word correction is used far too often to describe a fluctuation. That is because, as I noted at the beginning, we tend to sensationalize. We tend to exaggerate. We tend to extrapolate. And if you have a fluctuation, people want to call it a correction. If you have a correction, people want to call it a crash. But the one aspect of the term correction we haven't discussed is that it contains the word correct. Now, this is kind of fun when you think about it. This is to suggest that a market correction brings prices back, or sales, or both, to a level where they should be, i.e. correct. Now, I believe that with the benefit of hindsight, we could use the term correction to describe some segments of our market. I previously told you that Durham region increased 87.4% in 2 years, and then a 31.6% decline took place in 45 months thereafter. If we believe in the correct part of correction, prices are where they should be. You take that 87.4, then you take away the 31.6. That is, of course, over 2 years plus 45 months, right? So we're talking 6.5 years. And of course, we are back to where we should be. Now, in any event, I wanted to go through some of the recent articles about recovery in our markets and look at what various pundits are saying, because everyone wants to put a date to this. So let's start with an article featuring perhaps the most notable economist in our orbit, Benjamin Tal, with a headline that makes the timing of the market quite clear. Quote, economist Benjamin Tal sees housing market recovery in 2027 and a new normal, from the Globe and Mail, January 16th. So they've just told us right off the bat, there's the date. And I think that's partial clickbait, but I also, as you read the article, believe that this is what Mr. Tal thinks. Mr. Tal says, the way I look at it, I see 2026 as a transition year between something bad to something better. Okay, something bad was 2025 and something better is 2027. I mean, I never thought I'd say this, but I'm actually more bearish than Mr. Tal, because I think 2026 is basically going to be like 2025 all over again. Mr. Tal continues, I think the fundamentals are there. And the minute you have the supply story ending in the condo market, which should be 2 or 3 years from now, we start to see some upward pressure. Boom, there's a date, 2 to 3 years. We'll come back to that. Now, the article says people had been hesitant to buy because they expected more rate cuts. Mr. Tal says, I think the Bank of Canada made it very clear they're not going to cut anymore. Something really bad will have to happen for them to cut. So I think you will see more people entering the market realizing that it's the bottom as far as the Bank of Canada is concerned. That'll add a little bit more to the spring market. The minute you reach this point with interest rates more or less where they are, I think the housing market can show a nice recovery in 2027. Okay. So Mr. Tal describes 2026 as a transition year, which I thought 2025 would be. He then goes on to discuss the condo market. And I feel there's so much discussion of the condo market, either on its own or within discussions about the overall housing market, that what's getting lost in all this is the fact that the freehold market and the condo market can move in opposite directions. Not only that, the pre-construction condo market can move out of sync with the resale condo market as well. So we continuously talk about the market as though it's one thing, when it is, of course, made up of many different segments, and each of those segments can be further segmented. Now, Mr. Tao also made a bold prediction herein by using the word bottom to describe our market. Predicting a market recovery should follow the act of pinpointing a market bottom, right? Now, before we move on to other predictions, I want to draw your attention to a very important publication from Urbanation. January 21st, Urbanation wrote, new condo sales fall for fourth year to lowest level since 1991. I told you previously that we saw 1,599 new condo sales in the GTA in 2025. The Urbanation study provides us with two mind-blowing figures. The first is, new condo sales in 2025 fell 91% below the 10-year average. And secondly, new condo sales have dropped 95% since 2021. That's a crash. Now, the author Sean Hildebrand concludes with this take, quote, as the condo market enters the fifth year of its largest correction ever, the duration of this downturn should be a significant cause for concern as it relates to future supply. What? Concern about future supply? All the YouTube commenters, we're in a crash. I should get this condo for $444 a square foot. Toronto's a terrible city. Mr. Sean Hildebrand, who is the granddaddy of real estate data, is telling us we should be concerned about future supply. Yes, because we should be, because he's smarter than you and because the data says so. Listen to this. By the end of the decade, we know with certainty that there won't be any new condo completions. What we don't know is how far into the 2030s the supply crunch will last. If rental construction can't fill the void, it won't. This raises serious questions about the impact on affordability. Now, this goes beyond conversations about recovery, doesn't it? Mr. Hildebrand is already talking about the next bull run in the 2030s. He notes that there is significant cause for concern as it relates to future supply, which is the last thing that's on most people's mind in the midst of a pre-construction condo market collapse and a weak resale condo market. By the end of the decade, we know with certainty there won't be any new condo completions, is what he said. And that is something we've discussed on TREBB ad nauseum for the last 2 years. People are not buying pre-construction. Builders are not building. Builders will not complete. We will have no new units. Guys, like, it's not exactly a trail of breadcrumbs here. Now, this fascinates me because we've identified a problem a half decade before it's going to occur, and yet I don't think we're going to do anything about it. All the warning signs are present, all the data is undeniable, but when demand massively outpaces supply in 2031 or 2032, we won't be able to look back and say, there was no way to have seen this coming. Now, our media started to pick up on this. There was an article in Financial Post called, What Toronto's Worst Condo Correction Ever Will Look Like in 3 Years. Again, we're talking about a recovery. We're talking about 3 years. Now, that article essentially repeats what we've just discussed with Mr. Hildebrand and Urbanation, so we can skip through that to another article with the word recovery in the title, What a Condo Market Recovery Might Look Like, by the Globe and Mail, January 22nd. Okay, what it might look like. Tell us. Now, the article says, the conundrum for condo builders is that they can't start marketing new projects till all that surplus inventory is acquired, which means there will likely be a several year-long period in the near future when very little is being built and nothing's being sold. Then it goes back to quoting Mr. Hildebrand. By 2029, there will be virtually no new condo supply entering the market. The article continues, how long will the doldrums last? That question dominates industry conferences, and the Real Estate Bro podcasts not long ago featured excited conversations about how to goose returns by flipping pre-construction condos. Okay, I love the Real Estate Bro podcast reference because that is exactly who was flogging pre-construction condo garbage from 2018 to 2023. Then again, I'm in real estate and on a podcast, but I'm not a bro. I'm too old to be a bro. I was a bro once, let me tell you. Back in 01, you should have seen me in the bros at the gym at McMaster. Okay, so as for the predictions, they're specifically aimed at the pre-construction condo market's recovery, in case that's not obvious. Mr. Hildebrand suggests the pre-sale market won't recover until all the surplus inventory inventory is absorbed, which will be 2029. And then I would say 3 to 5 years, says Mr. Casano, didn't get his first name, but quoted in here, I assume in the building industry. I know that there are people in the industry saying, nah, this is 18 months. I just don't see it. Then it says Mrs. Keesmaat, Jennifer Keesmaat, of course. However long people think this is going to take, it's going to take longer. Thanks, Jen. So what we have there are a bunch of different predictions. So Mr. Hildebrand suggests that the pre-sale market won't recover until all the surplus inventory is absorbed, which will be 2029. Mr. Casano suggests 2039 to 2031 with his quote, nah, this ain't 18 months. And Mrs. Keesmaat provides an answer worthy of any politician by not providing an answer at all. Now, what I found more interesting in this particular article was that there were predictions of how the new model of pre-construction condo development might look. Now, you've heard me muse the following. In 2009, after the financial crisis in the United States, nobody walked into their investment advisor's office and asked to purchase a mortgage-backed security. So how in the world in 2030 is anyone going to walk into a condo sales center and say, can you please sell me a pre-construction piece of paper at 40 to 50% above prevailing resale with all of the caveats that existed when the market absolutely crashed? I just don't see it. Now, the article offers some insights into how developments might be financed in the future. Listen to this. For decades, condo builders and Canadian lenders relied on a financing model designed to attract small investors. They pre-sold 3/4 of the units in a building and used the deposits to secure construction loans, which would be paid off as soon as the building was completed and transferred to the condo corporation and investor owners. Of course, absolutely, we know this. Now, here's a quote. My contention is this idea was fatally flawed from the start. That what it did lead to, in fact, was speculative market for investors instead of people that would actually live in the units, says Mr. Greenberg, who was introduced to us earlier in the article. We didn't get a first name. A growing number of industry players concede the point, an acknowledgement that at a time when it was become almost impossible to pre-sell a condo, this particular financing model has brought the sector to its knees. We're just saying this now. So institutional capital, on the other hand, is flowing into large new rental projects, which require developers to take a lot larger equity stake and accept a longer payback period with lower returns. A popular CMHC rental subsidy program has prompted many builders to convert planned condos into rental ventures in order to secure funding. Do you see where this is going? Because I do. It sounds like we're going to ask the CMHC to backstop the entire condominium industry when things pick up again in 2030. And as a tinfoil hat wearing libertarian, I absolutely hate that idea because I don't think that the risk should be laid on the back of taxpayers. Now, further from the article, Mr. Casano and others say that CMHC programs geared at nonprofit housing providers such as Woodgreen have created a third option, with these condo developers establishing joint ventures as a means of accessing CMHC funding. Okay. Joint venture. It's a little bit better than throwing the entire thing on the back of taxpayers. Now listen to this. In Vancouver, meanwhile, a growing number of projects are being financed through a new vehicle known as a real estate development trust. Real estate investment trust is REIT. This would be a REIT. These are like REITs. That was a dad joke. These are like REITs in that they're available to smaller retail investors, but raise capital to finance new projects. So let me get this straight. We have 3 ideas here on how to finance new construction moving forward. One is we can use a CMHC, which of course I absolutely hate. I was just checking to see if I'm wearing my tinfoil hat. I don't think that taxpayers should be backstopping the entire condominium industry. Number 2 is REITs, an idea that I love since private capital should be used to finance private projects. And number 3, investors. So says Mr. Hildebrand, quote, investors will come back to the market. Can humanity not learn from its mistakes? Why would anybody enter this same system as the one that absolutely imploded? Now, let's go back to our discussion about market recovery, because I gave you a lot and I hope I didn't lose anybody there. But what we're seeing in the media is that a ton of attention is being paid to this idea of a recovery. Some people are giving dates. Some people are giving examples of how and when it could recover. And I really think that we need to look at the lowest common denominator in the market, which is, of course, pre-construction condos, because everything goes up from there. Here's another article. This one is super important in the context of recovery. See if you can understand why just from the title. Toronto Star, January 26. As Toronto condo sales flounder, one group is betting big and buying up units in bulk. You see where I'm going with this? Institutional capital. It enters the market before retail investors. So if you want to look at a recovery, you have to look at market bottom. No one knows market bottom until it's in the rearview mirror. But if you have groups betting big and buying up units in bulk, I mean, yeah, they could be absolutely stupid, but they're probably not. There is, from the article, there is one somewhat surprising group that's starting to snatch up these listings, known as assignment sales. Private equity and investment funds are betting that things will turn around in a few years. A sign the market may be at or near market bottom. Quote, there's a lot of funds that we work with, like equity funds. They're buying them up in bulk, says realtor so-and-so, managing partner at yada yada. They're buying them. They're renting them out. They're keeping them until 2030, 2031, and they're flipping them. I mean, I was with you until I heard we're flipping them. It sounds like the Real Estate Bro podcast. But fine, here's the appearance of the date again, 2030 and 2031. This is the recovery. Now listen, if you go and buy a distressed assignment sale in 2025, 2026, yeah, I think that you could turn around and flip them in 2030 and 2031 for a profit. So no disrespect intended to the individuals quoted in this, abso-freaking-lutely right. I just don't love this idea that we're gonna go back to flipping. That's how we got into this mess. The expectation of excess riches. So it seems, at least as it pertains to the condo market, that this is what these dates are referring to, 2030, 2031. We're talking about the recovery in the condo market, but what about the recovery in the freehold market? Guys, I would argue that that recovery is well underway already, and I'm going to get into the January data in a moment. So we could, of course, cherry pick. We could look just at the central core of the 416. I don't know that I need to look at Durham region to talk about a recovery in the market. I think in any major city, you start at the core, you start at the nucleus. And what I saw in January, and I'm going to show you the data, which you're going to say completely contradicts the empirical evidence, the anecdotes, the stories. What I saw in January was that anything worthwhile in the freehold market went absolutely nuts. Now, January, of course, we had a miserable snowstorm, followed by another miserable snowstorm. No one wanted to do anything. No one wanted to go out. Everybody just wanted to stay home. And interestingly enough, here's a good story. I had colleagues of mine that had an offer date scheduled for Monday after the big snowstorm, but they took a bully offer on a Thursday night. Would they have got the price that they were expecting after that big snowstorm? I don't know. Things are done virtually, of course. I'm just saying that, of course, there's a lot of timing and a luck and happenstance that takes place when it comes to selling your property for the highest price possible. But the snowstorm absolutely obliterated every open house, every buyer's plans that was going to go out on a weekend, and it had a huge effect. So I'll say this as far as January goes. Single family freehold in family oriented areas between 1.3 million and 1.6 million was absolutely on fire. Areas like Riverdale, The Pocket, Roncesvalles, Greenwood Park, these areas, in those price points, there were multiple offers everywhere. Now, it might be because of low inventory. It might be because of all the go-getters in January. But of course, as just discussed, most people just wanted to stay home. So let me run through January TREBB numbers as I see them. I will try to be unbiased. You tell me if I'm doing that, and I feel like here's where a lot of the disagreement is going to come. And I'm going to start with the average GTA home price, which was absolutely hammered. $973,289. It's the first time we've dropped below $1 million since February of 2021. So right off the bat, people are going to say, we just gave up 5 years. Okay, on paper, absolutely. But I went out before I did this podcast and I said to a few different people, okay, so the TREBB stats are in. What do you make of them? Here's a quote. I'm going to swear. Can I swear? I'm really sorry. And this is from a woman. Not that it really matters, but I want you to picture a woman saying this. This person said, it's fucking January, man. It was a goddamn snowstorm of a month. You want us to evaluate the market? Wait until March. I'm sorry for swearing. Very, very classy lady that said it's effing January, man. I think there's some truth to that. I think that if you do want to evaluate the market, you should wait until a much more important month, March, April. Now go to the comment section and say cherry picking, and I understand that, and it's totally fair. I'm not trying to discount January, but if you were to discount any months, it would probably be January, December, July, and August. So not going to sugarcoat it. 973, 289. Haven't seen a 9. Have not seen a 9 in 5 years. So we have been on a downward trajectory since the fall. We are in the dead of winter. There is nothing you can say to undo that figure. However, oh, here he comes with his however. However, if you want to look at year over year in Jan, it's going to shed some light on where things are. Because I just said that that's the lowest price since January of 2021. The average home price is down 6.5% Jan to Jan. That's TREBB. But listen to this. Halton's down 2.6%. Toronto, 416, is down 3.7%. York and Durham are both down 8.7%, and Peel's down 10.2%. So, I mean, good on Halton. But the point I made earlier is if you want to talk about a market recovery, I think that you start by looking at the central core, at the nucleus of any major city. And that always comes first. I talked to a colleague last night and was driving. We ended up chatting for 30 minutes. She called to ask me about a townhouse development in Mississauga. Next thing you know, you get to chatting. But that's how you know what's actually happening in the market. And she said, who cares what's happening in the suburbs? It's not because we don't work there. It's because when you're talking about a market recovery, that's going to come last. You've got to look central to see what's happening. Now, I just said the recovery is already underway. And then I said that the average price Jan to Jan is down 3.7% in January. So you could say, well, David, it's not really underway, is it? 3.7%, an average of 985 versus an average of 949. It's not insignificant, but it is in fact 1 month. And what I saw out there with limited inventory in the red hot family oriented areas in the first time entry level buyer price point was multiple offers everywhere. So Peel region down 10.2%, Toronto only down 3.7%. That's wild. But how about this? If you want to further look at that Toronto number down 3.7% year over year, we can further segment that as well. We'll break it down. Semi-detached, down 0.7. Detached, down 2.4. Condo, down 8.6. See what I mean? A market average is made up of other market averages. Any market can be segmented into smaller markets, which can then be resegmented into others. So we can take the GTA and we can segment it into Halton, Toronto, York, Durham, and Peel. Then we can take Toronto. We can segment it into semi, detached, and condo. So again, at the risk of being too bullish, I would argue that some semi-detached houses in Riverdale, Leslieville, Ronces, and Greenwood Park would have sold better in January of 2026 than 2025. And with a 0.7% decline month over month in one particular month in January, which is essentially a rounding error, I think it would be difficult to argue with me based on what I have seen out there in the market. So if you want to suggest that I am being too bullish, just yell, oh my God, David, 8.6% decline year over year on condo prices. Yeah, there's bearishness out there as well. And now we both win. So in terms of what typically happens with the average home price from December to January, consider, and I always like to look back at previous years, consider that from 01 to 2021, so we're talking 21 years, we saw an increase in home price 14 of those 21 years. Since then, it's gone down every single year. That's crazy to me. An average home price that declines from December to January, December is a depressed month. But in 2022 to 2023, of course, went down 1.2%. The next year, down 5.3%. The next year, down 2.5%. And then finally, from December to January, 2025 to 2026, we saw a 3.3% decline. Now, this is the fourth straight year that we've seen a decline from December to January, something we have not experienced since 2007 to 2010. So, not unprecedented, certainly, but also not the sign of a market that could be described as bullish. I am conceding on that point. Now, one more thing to consider. February will be higher than Jan. How do I know that? Because it's happened every single year. March will be higher than Feb. Well, it's happened almost every single year. So I'm not just saying this to be bullish. I am saying this because this is what always happens. December and January are low. February, March, April are always higher. The question is not whether or not it will be higher. It is how much. I believe the Toronto Real Estate Board, they put out a publication saying they expect the average home price to hover and to remain around $1 million. Now, you could say that they are a mouthpiece for the realtor community and that they're just going to say whatever they want to say. Listen, they could have said that it's going to go up 1,000,000%. They didn't. They said it's going to remain flat. Easy prediction. I will go on and say it won't remain flat because there are peaks and valleys, and it will in fact increase in better months as it does every year. Will it decline further to where were we, 973, 289 by next December? Possibly. I wouldn't bet on it. But the point is, if you want to look at an overall average over the course of the year, it will be made up of smaller averages, i.e. month to month. Those are fluctuations. Now, let's look at sales data. For context, in January 2021, craziest month ever, almost 7,000 sales. 2022, which is the second most ever, 5,600. So that tells you how insane 2021 was. Last month, snowstorm, low listings, terrible listing quality. I told my team, I think we're going to see 3,000 sales or less. Oh, okay. We saw 3,082. That is the second fewest in any January since I've been charting this data. 2009, we saw 2,670. I honestly can't remember what happened in 2009. I don't know, but that is the lowest. So 3,082 sales. And most of these sales guys are in the 4,000, mid 4,000 range. So that is certainly depressed. We're coming off a year, don't forget, last year, where sales were the lowest this millennium. I mentioned earlier in the podcast, sales were 122,000 in 2021. Last year, they were 62,000. Is it possible that we could have fewer sales this year? Go back to what Benjamin Tal said. This is supposed to be that transition year between something bad and something better. It looks like so far, we are essentially pacing last year. Now, sales declined from December to January. Why is this important? Well, sales declined 16.6% from December to January. Only once, and that is in 2017 to 2018, have we seen a larger decline in that period. Now, sales usually go up December to January. In fact, if you were to look at the chart that I'm looking at right now, sales have declined in 12 of 24 years prior to last, which means they've increased 12 of 24. That's how math works. So it's a 50-50. It's a coin flip. But usually you would expect sales to increase in January, and they went down 16.6%. So the last part of this, guys, is listings. New listings, there were 10,774 in January, which of course means nothing to you. The record, 12,570. So we're not that far off the record. But this is the sixth highest since 2002. So I've been talking to you about this lack of inventory, and you're like, well, David, this is the sixth highest since 2002. It sounds like there's a lot out there. The quality of listing out there is so incredibly poor. Now, once upon a time, Toronto Real Estate Board had this thing called the relist statistic, and they took it away. I don't know, because they don't want us to have access to our own data, apparently, because it was helpful. But if you were to picture an average market where 30% of listings are relists, and that was what I was tracking when we had this data in 2023, 2024, I would estimate that over 50% of all listings in January, new listings, were rehashes from last year. So yes, we saw almost 11,000 new listings, and that is not a small amount based on the last 25 years. However, the quality of listings was down, and there simply is no measure for that. So the last section here, guys, is a relationship between sales and listings. That's called the sales to new listings ratio. We call it the absorption rate. It was at 28.6%. That's really low. For context, the highest on my chart here, 2021, the sales to new listings ratio was 73.5%. 2022, it was 70.6%. I just told you it was 28.6%. That means roughly for every new listing, there is 0.25. Let's put it like this. For every 4 new listings, there's 1 sale. How about that? Now, that's the second lowest on the list. The lowest is 2009, as we just discussed. So one final point I want to make. If you look at the TREBB regions by absorption rate, Toronto's the lowest. The average I said was 28.6%. Durham region saw an absorption rate of 38%. Peel was 29.5. Halton was 29.1. York was 27.8. Toronto's at the bottom of the list at 26.3. But here's the thing. What does Toronto have proportionally more of than any of these other regions? Condos. So there's always a story within the story. The absorption rate's incredibly low, second lowest of all time. We divide the absorption rate by the 5 TREBB regions, and what? Toronto 416 is the lowest? Yes, but when you dig deeper into that and you see that most of that is because of the condo market, you start to understand. So guys, I'm going to summarize with 3 points. I'm going to put my glasses back on. I actually can see without them. 3 points are, number 1, the market continues to be in a period of decline. Sales are low, prices are down, absorption rate's low. I'm not going to deny that. Number 2, January was unusual, abysmal, and hard to use as a benchmark. Can I go back to my swearing female colleague that said, it's effing January, man? I don't necessarily disagree. Point number 3, here's where I might lose you. Some areas of the market are truly red hot, while others are warm, lukewarm, cold, ice cold, or non-existent. Non-existent being pre-construction condos, ice cold being resale micro condos, cool being the condo market in general, lukewarm being the freehold market, warm being the entry-level freehold market in the central core, and of course red hot, as discussed, all of the $1.2 to $1.6 million properties in family-oriented areas that looked good and ended up with, in some cases, double-digit offers. So there you have it. Crash, correction, fluctuation, recovery, January TREBB data. The conclusion, guys, if you're going to take one thing away from this, is that you can make numbers say anything you want. You can make arguments to describe your point of view. But if you really want to understand the differences between fluctuations, corrections, and crashes, you have to consider what percentage are we talking about and over how long. Not to repeat myself here, but if a market dropped 30%, you might call that a crash. If it was overnight, if it was over the period of 4 years, depending on the market or the product, it could be considered a correction. Hell, it could be considered a fluctuation. This is what I really wanted to explain today, because as we continue to see more and more articles using the words correction, crash, we talked about recovery, and maybe I apologize if that was the least interesting section of today's podcast, but all of those articles that I quoted from, they're all talking about recovery. People are fascinated by this topic of recovery. To understand where and when the market's going to recover, you have to look at the bottom. Who knows where the bottom is? I mentioned institutional investors are starting to pile money into the distressed assignment condo market because they believe that we are at bottom. In fact, that narrative will continue throughout the year. People love to sensationalize. They love to use hyperbolic words like crash, like recovery, and I don't think that's going to change in this media cycle. So that's it, guys, for me. A little long in the tooth today, but very important stuff. I hope you enjoyed. Thanks so much for watching. As always, if you want to leave me a comment in the YouTube section, you know I love reading those. Please remember to like, comment, or subscribe wherever you get your podcasts: Apple Music, Spotify, Napster, ICQ, MSN Messenger, MySpace. I'm just naming websites to tell you how old I am. And we'll see you here next time, guys, on The Last Honest Realtor.